Imagine the heart of Chicago's financial fortress, where the Chicago Mercantile Exchange hums with the relentless pulse of global trade. But on this crisp December morning in 2025, the air crackles with tension as alarms blare across trading desks worldwide, signaling a seismic shift in the silver market that no one saw coming quite like this. It's December 29th, and silver futures have just plummeted over $7 in a brutal flash crash, wiping out billions in leveraged positions and leaving investors reeling from what feels like a deliberate hammer blow from the powers that be. A 13% margin hike announced just days prior that's now igniting chaos and exposing the fragile underbelly of the bullion banks. As screens flicker with red arrows and frantic calls echo through home offices from New York to London, the question burns in every trader's mind. Is this the death knell for the silver rally, or the spark that ignites an explosive reversal in 2026? Turning today's pain into tomorrow's unprecedented gains? This isn't just market volatility, it's a battlefield where retail dreams collide with institutional might. And the stakes couldn't be higher for the everyday investor caught in the crossfire. To grasp the full weight of this moment, we must rewind to the quiet buildup over the holiday weekend, where thin trading volumes during what insiders call Ghost Week set the stage for amplified drama. A period when liquidity evaporates like morning mist, leaving the market vulnerable to wild swings that can make or break fortunes in minutes. The CME Group, the behemoth overseeing futures trading, had issued Advisory the 25-393 just 3 days earlier on December 26th, quietly escalating initial margin requirements for silver futures contracts from $22,000 to $25,000 per contract. A sharp 13.6% increase, effective after the close of business today, December 29th. This wasn't the first hike. Earlier in December, on the 12th, margins had already jumped 10%. But this latest move felt different, timed with surgical precision, amid silver's parabolic ascent that had seen prices double in mere months. Driven by insatiable industrial demand from solar panels, electric vehicles, and semiconductors in a world racing toward green energy. Critics whispered of manipulation, suggesting the CME was shielding the massive short positions held by bullion banks like JP Morgan and Citigroup, who had bet against the rise with hundreds of millions of ounces in paper contracts, now facing existential threats as physical shortages bit hard. As markets opened this Monday, silver surged to a record high of $83.71, a euphoric peak that sucked in FOMO-driven retail traders leveraging up to 10 times their capital, only for the rug to be yanked violently, sending prices cascading down to $74.47 in a single session. A harrowing $7 drop that liquidated thousands of positions and evoked memories of past crashes, but with a modern twist of algorithmic warfare and geopolitical undercurrents fueling the fire. The emotional whiplash was palpable. Veteran stackers, those steadfast holders of physical bars tucked away in safes, watched unmoved as their tangible wealth held firm, while novices panicked, selling at the lows and cursing the system that seemed rigged against them. Delving into the root causes of this margin, hammer drop reveals a tapestry of interconnected forces, starting with the CME's stated rationale of managing volatility through routine reviews. But peeling back the layers uncovers a deeper narrative of desperation in a market stretched to its limits by years of structural deficits. Silver, unlike gold, isn't just a hedge against inflation. It's the lifeblood of the Industrial Revolution 2.0, with demand soaring 15% annually as China and the US pour trillions into renewables, consuming over 1 billion ounces yearly, while mine supply lags at 800 million, creating a yawning gap that's drained COMEX vaults to historic lows of under 150 million ounces registered for delivery. By late 2025, inventories had plummeted 70% from 2020 peaks, triggering backwardation where spot prices exceed futures. A rare signal of acute scarcity that spooked regulators. The margin hike, critics argue, was no accident. It coincided with whispers of a Thanksgiving ransom earlier in the month, where shorts allegedly paid premiums to longs to roll contracts forward, averting a delivery default but merely delaying the inevitable. Geopolitics added fuel. Tensions in the Middle East and South China Sea drove safe haven buying, while India's remonetization and BRICS nations pivot from dollars amplified demand, pushing Shanghai premiums to $10 over COMEX quotes, a divergence that screamed manipulation. Emotionally, this felt like a betrayal to the retail crowd who had piled in after silver's 175% year-to-date gain, outpacing even Bitcoin, only to be rinsed by the hike that forced deleveraging. Cascading sell orders as stops triggered in a waterfall of panic. The banks, holding net shorts of 215 million ounces among non-U.S. institutions, faced mounting losses, with JP Morgan alone disclosing a $4.875 billion unrealized hit. A distress signal that rippled through the system and hinted at broader fragility. As the crash unfolded in real time, bank distress signals flashed like beacons in the night, painting a picture of institutions teetering on the edge as the Federal Reserve stepped in with a stealthy $17 billion repo injection the Friday after Christmas. Interpreted by analysts as a covert bailout for margins choking on imploding positions. Picture the scene. Procurement managers at Tesla and Samsung, eyes widening at the $83 peak. Then grinning as the drop hit, hitting buy on hedging software to lock in tons at 74, turning the manipulation against the manipulators and absorbing the paper, selling into physical deliveries that further drained vaults. The human element here tugs at the heartstrings. Imagine the veteran trader, scarred from 2011's peak when similar hikes crushed the Hunt brothers' squeeze. Now watching history rhyme as algorithms executed stop hunts with cold precision, flushing weak hands while smart money waited in the shadows. X timelines exploded with outrage, posts decrying the hike as a tool to protect shorts, with one trader lamenting how it removed the average buyer's ability to demand delivery, effectively gatekeeping the physical market for whales. The emotional highs peaked as silver compressed its ratio to gold from 60 to 57, outperforming even on crash day, a relative strength that whispered of underlying bull strength amid the chaos. Yet, beneath the distress, seeds of reversal sprouted. The hike, while painful, reset open interest, clearing excess leverage and making silver more attractive to pension funds, eyeing January entries at discounted $78, far below the 83 flash. Transitioning from the immediate turmoil, we uncover how this margin-induced crash, far from ending the bull run, positioned silver for an explosive 2286 reversal, a narrative woven from historical precedents and forward-looking fundamentals that promise to elevate the metal to triple-digit heights. Recall 1980, when margins soared and prices crashed from $50 to $10. But that was a speculative bubble without today's industrial backbone. Now, with solar alone projected to consume half the annual supply by 2030. The shortage is structural, unyielding to paper games. The crash validated supports at 75, old resistance turning new floor, as industrial bids stepped in aggressively, pushing back to 78 and confirming the staircase build higher. Emotionally, this fosters hope amid despair. Physical holders, unmoved by the volatility tax on leverage, gain insight into silver's potential. The 83 flash, a preview of untapped energy like a beach ball held underwater, ready to erupt when suppression slips. Geopolitical hedges amplify this, with wars looming and currencies devaluing. Silver's no counterparty risk shines, drawing capital from cash-fearing bank failures, putting a firm floor under prices. As we approach the monthly close on December 31st, a finish above 75 would etch the highest ever, overriding daily noise and signaling to institutions that the secular bull, lasting a decade or more, has begun, compressing ratios and attracting billions in fresh money. Building to the climax, today's events crystallize the battle lines, banks digging deeper shorts to defend 80, burning ammo in a war that can't win as miners strike, refusing to hedge into volatility, and stackers hold tight, starving supply exactly when needed most. The $17 billion bailout feels like kicking a heavier can, increasing explosive potential for the next leg up, where pension funds, viewing 78 as a bargain, post-83, flood in come January. Resetting the game for parabolic moves to 100 or even 200 by Q2 2026. The emotional pinnacle hits as we realize this crash wasn't random but tactical, flushing gamblers to make way for structural buyers, a cleanse that's bullish in disguise. Echoing X posts warning of containment preceding repricing, where silver's undervaluation flips the script on gold. The wick on today's chart, that long upper shadow of rejection, creates resistance at 83. But history shows such speed bumps and low-volume holidays are mere pauses, not peaks. Especially with gold anchoring at 4,500, the adult calming the high beta sibling. Yet, as the storm subsides and we reflect on this volatile day, the narrative resolves into empowerment and optimism. A satisfying coda where survivors, those with diamond hands who endured the rug pull, emerge stronger. Positioned for glory in a bull market that demands resilience. The end-of-year checklist beckons, audit leverage, de-risk to physical or paid-up miners. Ignore intraday noise in the coming chop between 75 and 80, and prepare for January's wall of money that sees today's dip as opportunity. The margin hammer, brutal as it was, cleared the runway for heavy jets. Pension funds happy to buy at 78 rather than 83, increasing the January effect's probability amid a compressed gold-silver ratio signaling outperformance ahead. For US and UK audiences, this story resonates deeply, a reminder of monetary fragility in an era of debt mountains and energy transitions. Where silver graduates from commodity to strategic asset, offering protection and exposure to the boom. As 2025 closes on a triumphant note despite the violence, with silver up 10% from last week's close, the trend remains up, the breakout intact, and the physics of shortage demand a repricing that could redefine wealth. You've weathered the test. Now let the reversal unfold. Subscribe for more insights. And remember, in precious metals, the real winners are those who hold through the fire, emerging forged and unbreakable. Thank you for staying with me till the end. Here on The Scope, we dig past the headlines and uncover the hidden layers history tried to bury. If this documentary made you think differently, hit subscribe. Your support tells me to keep creating deeper investigations. Share this video with someone who loves powerful untold stories, and leave your thoughts in the comments. I read everyone. A new, even stronger documentary is already on the way. So stay curious, and I'll see you again soon, right here on The Scope.